So that's really the first.
In this video,
step
we're going to talk
here.
about interest rates
Is the
and
dividend
bond
constant?
valuation.
For some companies,
In general,
young
we want to follow some
they
basic
have
rules.
fluctuating
We've
growth
talked in
rates.
some previous videos.
Think about a
that the
company that
value
is
of an
innovative. They
is
have
the
a new
present
product.
value
So
of
while
all
when they
future
invent
cash
this new
flow.
product and they
So
start
when we
to sell
think
it,
about investing in
essentially they
securities,
have a
we need to
monopolistic
have that same
opportunity on
approach.
selling this product. So
We
they're
need to
going
be
to
able
have
to
extra
forecast
high returns on
future
that
cash
product.
flows and
However,
incorporate them
eventually
into some
somebody's
techniques
going to figure
that can
out
help us find the
how
value
to,
of stocks and bonds.
create that product.
So
and
let's
do
talk
it
about
cheaper.
bonds.
So
Of course,
eventually
it's
the
a legally
company will have to bring
binding
its prices down,
agreement.
etc. So
It has
that
a maturity
the
date
growth rate
is a
will
loan.
change in the future. So
The
we
time
have a
remaining,
model that
obviously,
you
is
can
the
use. It's
time
called the
until it
supernormal
matures.
stock valuation
Most debt
model.
is
It's a
issued with at
worksheet.
least
And
30
again,
years.
we have this product.
There
right,
is
so it's
some
gonna be
debt
able to pay
that's
dividends
issued with as much
at an
as
above
100 years
normal
of
rate
maturity,
of 12%
and
for
some
the
as
next
low
4
as
years.
5 or 10 years,
After
depending
that,
on the need
growth
for
rate's
the
going to go
company.
back to the industry
The face
standard
value,
of 9%.
the actual
The most
amount
recent
of the
dividend
loan
was $4.25.
is always $1,000.
Required return
So
on this company's
the
equity is
principal
20%. What
that
is
we'll base
the
interest,
value?
etc. on
So again,
is all
plugging our numbers
based
in
on
here, we don't have a stock
$1,000
price. We
loan.
don't need that. But the value
The
of this
coupon
stock,
rate
we find
determines the
here's
actual
the present
interest
value
rate
of the
paid.
first
This is
4 dividends.
obviously expressed as
It then
APR,
also
so it's an
calculates
annual
the
number.
value
And the payment
at the end
is
of
just
the
going to
time
be
frame,
the coupon
and
rate.
then it calculates
the
the
face
value of the
value.
combined
And then, of course, you
present
divide that
value
by
of
the
the
number of
dividends
coupon
plus the
payments per
present
year.
value
So
of the
typically,
price at the end of the 4
in
years.
real life,
So this
most
stock would have a
corporations
value
and the
of
government issue
$46.31.
debt that is paid interest semi-annually.
Again,
So
we have two
the
models.
denominator
One
here
assumes
would be a
constant
2.
growth, and one
For our
assumes
purposes in the class, it really doesn't
growth rate that
make
changes.
that much of a
in a more
difference
complicated version
value-wise
of this
as
variable
we
growth
discuss
rate model.
the value
we can
of
have
bonds,
it changing
etc.
more frequently.
That
That's a
extra
little bit above
couple of
my,
payments
programming
doesn't
ability,
make that much of a
but
difference
it shows
in
us
understanding the
that
concept.
there are different kinds of stocks.
As a primary
with respect
principle,
to
again,
growth
we've been
rates.
talking about this, the value of
So there's
financial
a
security
tremendous amount of
is the value of
uncertainty
expected
with
cash
forecasting
flows. So
dividends
we
in the
need
future.
to know what
right?
the present
Small
value
changes
of
in
the
growth rates
coupon
can lead
payments
to
are.
very
And of course,
large
we know the par
changes in
value
stock
is
price.
1,000.
So we do have
As
to be
we've
very
discussed
careful
in some previous
about
videos,
how
we also know that
change
interest rates and risk
how we
are
utilize
inversely
this
related to
dividend growth
value.
rate model.
So as
It's very
interest rates
popular.
go up,
It's not that
or as
difficult
the
to
risk of a
apply,
company increases,
but as with
the
all
value
models,
of its
there are
securities
weaknesses
should go down.
associated with it. So that's the end of part
So we have
1 of the
basic
stock
investment
valuation.
rules. We've been talking about these in some other videos as well. If the value of an asset,
Okay,
that
this
is what it's
section of,
worth, if
chapter
it's
9, we're
greater
gonna
than or
continue
equal to its
discussing
current market
some
price,
different
then you would
payout
want to buy
or
it.
valuation
And this
models
is just
that
a
can be
cost-benefit
used,
analysis.
for
If
stocks.
you get more than what it
So
costs,
if you think
you
about
would want to buy it.
payout, right?
We can
What does a
also
company
look at
pay out?
percentages,
From its net
though.
income.
If the
The company
expected
can either
return
pay cash
is
in the form
greater
of
than or equal
dividends,
to the
they
required
can
return,
keep something.
again,
They
you would
almost
buy it.
always do,
Now,
which is they
remember
keep
that
something
the
and it
required
goes to retained
return
earnings.
includes
But there
inflation,
is
it
another
includes
way
risk.
that
The
shareholders
expected
get money
return
besides
is the yield
dividends,
to
and that
maturity.
is
It's the
by the
actual
company
return
buying
you
back the
receive
stock. Now,
if you were to buy
the only
this
challenge we
asset
have with
and
this
hold
is
it to
if a company
maturity.
buys back your
So
stock,
again, we
you are
have
now
these basic
no longer an
investment
owner.
rules that we'll
But
discuss and
this
follow
is a
throughout
distribution
all
of
of
cash
the
to
videos.
owners, so we want to have
A zero
model,
coupon
if you
bond
will,
is a
to,
different type of an instrument.
to
It
describe
doesn't make
or
coupon payments.
to help
There's
us
no
to
interest
quantify,
paid.
if you will, the
It sells at
value
a
of
discount.
common
That is,
stock.
the price
essentially,
will
the
always
present
be
value of the
less than
stock
$1,000.
Is the present
The
value of all
typical
future
zero
total dividends
coupon bonds
and any
are treasury
repurchases
bills.
that have happened.
Now these are
And of course, we
typically
divide that by
less
the number
than
of
1
shares.
year old, but there
This
are
is going
some
to give us a different kind of an
instances
answer,
where we
though.
could have
This
longer than a
answer
year
is a
a bond
value of the
issue that
firm's
has a
equity
zero
rather
coupon
than a
that
single
is a government
share.
issue.
Right? We're going to discount
There
total
could also be
dividends
corporate
and share
issues
repurchases
that have
And we're
zero
going to use this
coupon.
using the
Well, let's
growth
see
rate
how
of
we would
earnings rather
calculate,
than the earnings
in this
per
case,
share.
we want to
So
talk
we're going
about
to come
the
out with a
interest,
slightly different
right?
number
So
initially.
we have a 1 year
So here's an
risk-free
example of
zero
this formula
coupon bond. Has $100,000
using the
face.
total
Initial
payout
price
model
is
worksheet.
$96,000 odd
Right?
dollars.
You can see here what the data is
So
that we
if you were
need
to
for
look at
this
a
worksheet.
timeline,
We need to know
This
how
is the
many shares
particular
have been
timeline that you
repurchased,
would see
the
for this
amount
investment.
of dollars spent
Although the
on
bond
repurchasing
pays no
shares.
interest,
We need to know the
right?
weighted
the
average
compensation
cost
you
of
get is the
capital.
difference.
We can get
so
that
give or take roughly
from a site called
$3,400 odd dollars
WACC.com.
is the compensation
We
you
can go to
get
that site, you put in your
for
company's
purchasing
ticker
this
symbol, and it will give
particular
you this cost of
investment.
capital.
If you look below,
Now
as
you put
we
in the
plug
number of
in our
shares the
numbers,
company has,
this is the
the
bond
dividends
valuation
that were paid,
worksheet.
and then we have to have an
Now, as you
estimate
look here,
of
we also
earnings per
see the
share
what?
growth. And
100,000
all
is
of
the
this
par
data
value,
can be found
96,618
either
is
at
the
this
price.
website
The
or
yield to maturity, this is
um,
the return you would receive.
on Yahoo
In
Finance.
this case, equates
So when you plug
to
the
the
data in
risk-free
here, we
rate
end
of
up
return.
having a value
So in this
of
case,
this company's stock of
we would say that
TAP
this
here, of course,
risk-free rate
of
is
$22.77.
3.5%.
And of course,
Now we can
need
also
to make
look at
comparisons
some
of that
other types
to
of
current
data
market
that we're
price
given.
to
In this
determine
case,
what
we're
we want to
told
do as far
that
as
we have a series
maintaining
of
the
zero
stock, keep
coupon
it,
bonds,
or maybe
and they're
we
all
want to
trading
sell
at
the
less than 100, so they're all trading at less than par.
The next
so
thing
they're
we want to
discount
talk about
rate bonds.
is
And
another
these are the
version
prices of these
cash flow.
based on
Instead
$100
of using
face
dividends
value.
as our
So
variable,
if we wanted to
in
do
this
this
case,
on
we're going to look
$1,000
at the
face
free
value,
cash flow
all we
of
would
the
do is
company.
move the decimal place
So the discounted free cash flow
one to
model
the right. But again, if we plug this into our
looks
bond
at and measures something
valuation
called
worksheet,
enterprise value.
again, we see that
And
the value
enterprise
is
value
100,
is just the
price
market
is
value of the stock
87.63. If
plus
we're doing
the
this
debt
3-year version,
minus any
we now
cash
find
that
out
the
that for
company
this
has.
bond,
So
the
what this
actual
tells us
interest
is
rate,
what is the net
the
cost
spot interest rate,
of
that's the
buying
interest rate
this
you would pay to buy
company,
it
lock,
today,
stock, and
you would
barrel,
roughly earn
by paying off all of
4.5%.
its debt and taking the company
So let's come
now
back and think
as an
again about
unlevered
yield
business.
to
So
maturity.
you're going to buy the company,
It's
pay
the
off all
single
the debt.
discount rate that
Now you have a
equates
company
the
that has
value of
zero
a bond's
debt,
remaining cash flows
and you own
to
all
its
the
current
assets
price.
of the company.
And I think this is
So,
one of the
if we
worst
look at how we
definitions of
calculate
yield to
free
maturity
cash
you can
flow,
have. Yield to maturity is the
EBIT,
rate of
earnings
return
before
you
interest
earn
and taxes
if
times
you
1
buy the
minus
bond at the
marginal
current price,
corporate
P
tax
zero,
rate,
and you
plus
hold it
depreciation.
to maturity. This is what
We then
yield to
subtract
maturity
from that
represents.
capital expenditures
Yield to
and
maturity
any
on a bond
increases
selling at
in
par
net
value
working
is
capital.
going to be equal to the
So
coupon
this free
rate.
cash flow again
So again,
tells
we
us
have some
a free
benchmarks
cash
as
flow
we
is
talk
the
about
cash that's
interest,
available to
etc.
pay both
We need
debt
to understand
holders
how
and
interest rates
equity
affect
holders.
value
So
and
our
where the
discounted
values
free cash
fall
flow model
relative to
is
the
going to be
principal
the present value
of the
of
bond.
the future free
So
cash
let's look
flow
at an
of the
example.
company.
Here we have
So
a bond
P0,
that's selling for
right?
$450.
It's the value of the company
$1,000
right,
the
plus
par
the
value. As you
cash
see it as a
minus
zero
the debt divided
coupon,
by
so
the
it's a
shares
zero coupon
outstanding.
bond.
Now,
Required return
since
is
we're
8%.
discounting cash flows
So the value
to
of
both
this
equity
bond
holders
is
and debt holders, these free cash flows
$463.19.
should be
Now, if
discounted
you follow our
at
rule,
the
it says
weighted
what? If the
average
value,
cost of capital.
if the value
Again, this is that number
greater
that we
than the
would get
price,
from that's
you would buy this.
WACC.
Would you pay
right?
$450
If a company has zero
to get
debt,
something worth
then their cost of
$463?
financing
And of course
is
you
the
would.
same as the cost
If
of
you
equity.
wanted to get
So again, we just
8%,
need to know
which is the
what
required
discount
return
rate to
yield.
use.
And if you
So the
purchase
value of
this
this
for $450,
company,
you would
how we
earn
find this using free
8.3%.
cash flow, is very similar
Again, would you want
to
to
the
buy this
dividend
bond? And
model.
of course,
Except
the
in this
yield,
case,
the
the
expected
numerator
return
has free cash flow
is greater than
and
the
the
required
denominator,
return.
instead of
So
it
this
having
is a
the
bond
cost of
that we would like
the
to
cost
buy.
of equity, it's the
Plugging
weighted
in now
average
a
cost of
coupon
capital.
example,
When we expand this,
5%
right,
is the
through the same
coupon. We have a
process
price
did
of
with discounted
8.25.
dividend model,
Again, looking at
we
bond
end up
value,
with a formula such you
would you
take
pay
next year's
$8.25
forecasted
to buy
free cash
something
flow
that was worth
and divide that by
$798?
the weighted average
Hopefully your
cost of the
answer is
company
no. if
cost
you
of
did
capital
buy
of the company
this,
minus
you wanted to get 8%,
the growth
but you would only
of
earn
future cash flows.
7.56%.
Again, most of this data can be
So again,
found
this is an
somewhere
example then
out on
of
the
a
web.
bad that is a poor
So how we use this,
investment
the value
choice.
that comes, again, this is the definition here of this enterprise value, right?
Graphically,
The value of the
looking at
company is the value of
yields
the
and
stock
bond
plus
values, I think you can see here that there is a
value of its debt
declining,
minus
a
its
negative
cash. So if we
slope
solve for equity
of our slide that
vis-a-vis
shows that
here
as
is the
discount
value of the
rates go up,
company's stock,
values go down.
of its common equity section.
In this
if you will.
case, where the
So here we have a
coupon
company,
for this particular
estimated
bond
growth
is
7%. Most
6.38%,
recent was
where that
700,000.
crosses the
The firm's weighted average cost
$1,000
of capital
mark
is
here.
13%.
That is the
So we
yield,
plug this in our
where the
formula,
yield
we
to
find out that
maturity
this company
would
is
be
worth
equal to the
$12.48
coupon
million.
rate. Anything
The
less
company's got
than
$1
that, the
million
bond will
in
have
cash,
greater value
and the market value
than
of their
1,000.
debt $7.5
Anything more
million.
than that, it would
They have
have
100,000 shares.
a
So
lower
what is
value
the
than
value of their
1,000.
equity? And then
So what
is
we
there a per share
refer
number
to
that we
this
can
as
look
the
at?
terminology is discounts
The
and
formula,
premiums.
right? We take the 12.48
So a bond is selling it at
minus
discount
the
rate,
7.5 million.
means it's selling
Add
at less
back the
than
cash.
face. If it's
So
selling
the
at a
stock,
premium,
the equity of this
it is
company
selling
is
it greater than the face.
$5.983 million.
Now this really means nothing with
so
respect
that
to
is
value.
the value
It
of
just
the
gives
equity.
us an
To buy
indication
the whole company,
as to whether or not
you
this
would need
bond is selling
12.48
above
million.
or below
That's what you would
the,
need to buy the whole
premium
company
or
and
the
take
par
it
value of the stock.
private. Right, the same free cash flow valuation.
So
Here's
again,
the data we need to know. We need to know how much
we
cash
just
they
need to
have,
understand,
total
relatively
debt.
speaking,
We
where
need to
does
know
the
what their
price
free
fall?
cash flow
How
has
can we
been historically.
rationalize
For
this?
our
How can we
example, for the
explain
class,
this in
for the
maybe a little
company
bit
that
better
you're
terms?
looking at, this number is
And you
calculated
can
in
prove
the
this
ratio
mathematically
section
by plugging
for
in the
your
numbers.
company.
But if a
Right? We need to
bond
know
is
what
selling
the
at a
growth
par
of free
value,
cash flow is.
essentially
This
what
number
that's
can be
telling us
found in,
is that the coupon is selling
Yahoo
is
Finance.
higher than what
And then we need to
might
estimate
expect.
next year's free cash
So
flow
if the
if
coupon,
they actually give us
if the
that
interest
number.
that you're
And
paid
in
is
this
more
case, they
than the
actually
return
give us
that you
number.
expect to get
where it
from the
says
bond,
if
the
free
yield to
cash flow
maturity.
1 is given,
If it
enter
is
it
more,
here.
then you're
I got
willing to
that number
pay to
from,
get more cash.
Yahoo Finance.
And this hopefully will become clear
Again, when you
as
plug
we
in all
conclude
the
the
data
videos
here,
on,
right, plug
on
in the
bond
numbers,
prices.
we end up with the market
At the
value of
bottom,
debt.
if
We have this
it has a
8.24
low face value,
million.
it's selling
We
below
cash is
par.
624.
That's telling us that the
so the
coupon
market
rate
value of common
is less
stock
than the
is
yield to maturity. Now, how can this happen?
11,872.
It
I believe
happens
that's in
because
millions.
interest rates
And
change.
then
The
to find the
coupon
number
rate
of
is
shares,
fixed.
we know we looked that up.
It
It's
never
87.1 shares.
However, the
So
yield
the
to
value
maturity
of the common
changes
stock using
as
this
interest rates in the
cap free
economy
cash flow
change.
model
It changes
places
as
the value
discount
of the
rates
company's
change,
stock around
changes as risk in the company changes.
$63.49.
So the
Now, the
yield
nice
can
thing about
change
this
from
free
time
cash
to
flow
time,
model is
but the
it is
coupon
directly
rate
connected
is
to our
always
capital
going to be
budgeting
fixed.
process. Right?
So
A
here we
company's
have an
free cash flow
example,
is equal to
right,
the
where
sum
we have
of
a
the
bond,
free
they
cash
issued a bond,
flows
has
from
7
its
years to
current
go,
investments
4%
and its
coupon,
expected
and
future
the annual
investments.
coupon payments.
So we can
excuse me,
interpret
4%.
firm
If the current
enterprise
interest rate's
value as
3%,
being
what
the
is its
total net
premium
present
or
value
discount?
of the firm
Well, if you plug
what
it
it
in,
will
you'll find
earn
out
for
that
its
the
existing
value of this
projects
stock
and other
is
projects that it is
$1,062.
anticipating.
So the premium
Right? So the net
is
present value of an individual
$62.30.
project represents
If
its contribution
the current interest
to
rate
firm's
changes from
enterprise
3
value.
to
So to
6%,
maximize the
first of all,
firm's
what's
share
going to happen to
price
value?
and its
If
enterprise
interest
value,
rates go up,
we should
bond
only
prices
accept
fall.
projects that have
So that means that
positive
the
net
value
present
is going to
values.
then fall to
Now,
$888.
where we've come
which
so
is
far
less
in
than
this
1,000.
valuation
So now it's selling at a
process
discount.
is we really have talked
So in
about
this
three
case,
basic
it's
models.
give or take
A
about
dividend
$111
model, the total payout model, and the free cash flow
would be the
model.
discount rate.
And the
It's
importance
just
of
the
the three
1,000
models is it really
minus
gives us
the 888.
pictures of three different things, right? The dividend model estimates stock price. The total payout model
So I
represents
will look
equity
forward to
value.
talking to you in
And the free cash
next
flow model
video.
looks at enterprise